Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into one of the most fascinating and high stakes areas of the financial world: global macro hedge fund tactics. This episode is all about understanding how hedge funds think on a global scale, how they anticipate seismic shifts across economies, and what strategies they're using to navigate what looks to be a very eventful year ahead, 2026. We'll explore the best macro hedge fund strategies, why this coming year is such a turning point, and how you, as an individual trader, can take lessons from the pros. And as always, I'll point you to some resources that can help you put these insights into action in your own trading. So let's get started. What makes global macro funds, special global macro hedge funds, are not like your everyday stock picking funds. They're not combing through company balance sheets or earnings reports trying to find undervalued businesses. Instead, they're operating with a wide angle lens. Their focus is on big picture economic forces, things like interest rates, inflation, trade balances, geopolitical events, and even technological disruptions. And unlike other hedge funds that might stick to equities or credit, global macro funds can position themselves across almost any asset class. They trade currencies, betting on dollar strength or weakness. They move into government bonds, timing interest rate moves. They play commodities, whether it's oil, gold, or lithium. They trade entire equity indices, not individual stocks. That flexibility makes them powerful. It also makes them complex because they need to understand not just one market, but how markets interact with each other globally. Why 2026 is a turning point now? Why focus on 2026 specifically? Well, there are several reasons this year is shaping up to be a landmark for global macro investing. First, we're reaching the end of the post-COVID cycle. The last few years have been dominated by pandemic disruptions, stimulus programs, inflation spikes, and aggressive central bank tightening. By 2026, markets will either be finding a new balance or entering another round of turbulence. Second, central banks are at a crossroads. Will the U.S. Federal Reserve cut rates aggressively, or will inflation force them to hold steady? Will Europe and Japan move in sync, or take completely different paths? Divergent policies like these are a playground for global macro funds. Third, we're living in an era of multipolar geopolitics. U.S.-China rivalry, conflicts in Eastern Europe and the Middle East, and shifting alliances mean that markets can turn on a dime. And that's exactly when macro funds shine. Fourth, the tech supercycle. Artificial intelligence, automation, and digital finance are reshaping productivity, labor markets, and capital allocation. Hedge funds will need to judge not just what's happening in markets, but how technology is reshaping economies themselves. And finally, the climate and energy transition. The world is still heavily dependent on fossil fuels, but the push toward renewables and electrification is accelerating. This creates constant opportunities and risks in energy and commodity markets. So, when you put all of that together, 2026 looks like a perfect storm of opportunities for the best macro hedge fund strategies. Breaking down the strategies, let's go through the main strategies that macro hedge funds will be leaning on in 2026. Number one, global interest rate arbitrage central bank policies are not aligned, and that creates opportunities. Funds might go long on U.S. Treasuries if they believe the Federal Reserve is cutting rates quickly. At the same time, they could short European sovereign bonds if inflation in Europe proves stickier than expected. Another favorite play is yield curve positioning. For example, if traders expect long-term inflation to rise, they may short longer-dated bonds and go long shorter-dated bonds, profiting from the curve steepening. These are sophisticated trades, but they're at the core of how macro funds capture bond market dislocations. Number two, currency divergence trades. Currencies are incredibly sensitive to central bank moves and economic momentum. In 2026, we could see the dollar weaken if U.S. policy loosens faster than others. Commodity-linked currencies like the Canadian dollar or the Australian dollar might rally if oil, metals, or agricultural demand stays robust. Asian currencies will also be in play, especially if China ramps up stimulus to support growth. Macro funds often use options to position here, limiting downside while capturing potentially explosive moves. Number 3, commodity supercycle bets. Commodities are a global macro fund's best friend, especially in volatile times. In 2026, oil prices could spike on geopolitical supply shocks. Industrial metals like copper and lithium are set to remain in demand as clean energy adoption grows. Agricultural markets may see volatility linked to climate events. Funds don't just take outright long or short positions, they also use relative value trades. For example, they might go long copper while shorting aluminum if they believe copper demand will outpace aluminum. Number 4, geopolitical event risk. Global macro managers thrive on uncertainty. Elections in the US and Europe, shifting leadership in emerging markets, or flare ups in global conflicts create volatility. Hedge funds prepare for these events with hedges, volatility trades, or directional bets. They know that political outcomes can reshape currencies, bond yields, and equity indices overnight. Number 5, equity index macro exposure instead of stock picking. Macro funds often play equity indices. In 2026, they may go long tech heavy US indices if artificial intelligence drives earnings growth. They may short European equities if energy costs squeeze margins. Or they might balance exposure by going long emerging markets while shorting developed markets. This is about capturing broad macroeconomic themes through equity markets. Number 6, systematic and quantitative overlays. Finally, we can't ignore the role of technology. Many funds now use systematic models powered by machine learning. These models parse central bank speeches, analyze satellite data on commodity flows, and forecast currency volatility. In 2026, the most successful funds will be those that combine human judgment with machine-driven execution. Lessons from history. It's worth remembering that global macro strategies have a long history. They've produced some of the most famous trades in finance. Think back to George Soros and the British pound in 1992. Soros famously bet against the Bank of England and made more than $1 billion in profit. Or the 2008 financial crisis, when funds that shorted mortgage-backed securities and went long U.S. Treasuries had extraordinary returns. Or more recently, the COVID-19 crash of 2020. Funds that anticipated the rush into safe haven assets like gold and treasuries were able to protect and even grow capital during a global meltdown. The lesson is clear. Macro strategies work best in times of disruption. And that's exactly what makes 2026 so interesting. Risk management, the real secret now. Let's be clear. Global macro investing isn't about being right all the time. It's about managing risk so that losses are contained and wins are maximized. The best macro hedge funds use diversification across currencies, bonds, commodities, and equities, dynamic hedging with options and futures, strict leverage controls to avoid catastrophic losses, scenario planning for extreme events. They know they can't predict the future with certainty, but they can prepare for multiple outcomes. That's the real art of global macro. What individual traders can learn. So how can individual traders take lessons from these billion-dollar funds? First, think big picture. Don't just watch individual stocks. Follow central bank announcements, inflation data, and geopolitical developments. Second, diversify your trading. Don't limit yourself to equities. Look at commodities, bonds, and currencies. Third, be disciplined about risk management. Even with a small portfolio, stop losses and diversification matter. And finally, use the right tools. Having access to a world-class, cutting-edge, user-friendly trading platform app makes all the difference. If you're serious about trading macro strategies, check out the crystalballmarkets.com platform. It's built to give traders professional-grade execution in an easy-to-use interface. Education. The edge you can't ignore. One thing all great macro traders share is a commitment to continuous learning. They're constantly consuming data, analysis, and news. For individual traders, one of the best ways to build this edge is through podcasts. And if you want a beginner-friendly guide to trading, investing, macro, and financial markets, you should definitely subscribe to the Crystal Ball Markets podcast. It's an excellent resource for breaking down complex macro ideas into clear, actionable insights. Looking ahead to 2026, so what's the big picture? The global macro investing strategies 2026 will revolve around adaptability. Hedge funds will need to navigate central banks moving in different directions, commodity shocks tied to climate and geopolitics, currencies that swing with growth expectations, and technology driven transformations. For individual traders, the message is simple: think big, stay flexible, manage risk like a pro, and keep learning. Closing all right. That wraps up today's episode of Financial Market Insights for Traders. Remember, if you want to trade smarter, check out the Crystal Ball Markets platform. And if you want to learn faster, subscribe to the Crystal Ball Markets podcast. Thanks for joining me today. I'm Sophia, and I'll see you in the next episode, where we continue to explore the strategies, tools, and insights that traders need to navigate today's markets.